I would like to extend our warm welcome to our special guest, Bob Seeman. He is the Managing Director of Cyberscope, who will be sharing insight with us. Bob has a wealth of experience advising both businesses and government on emerging technology. He is also author of The Coin Man, offering a comprehensive critique of Bitcoin. Bob background serving as a senior advisor as Endeavor co-founding of Ravicops and consulting for various cryptocurrencies related venture. He brings a unique perspective as a California attorney, electrical engineer, entrepreneur, with experience ranging from Microsoft and London consulting for the European Commission. Today's session will be recorded and uploaded to our YouTube channel. For those who couldn't join us, we will preserve some time at the end question and answer session. So once again, thank you for being here. And without further delay, we devolve into a discussion on CBDC and stablecoin. So I will go deep. First, I would ask a question related stablecoin, private money. So Bob, how do stablecoin work, and what role they play in the digital economy today?
Before I answer that very good question, I would like to point out, while my background is very wide-ranging that you've laid out, one thing I am not is a banking or finance expert. So these issues of stablecoins and CBDCs, they're about as multidisciplinary as it gets. It involves legal, technical, banking, finance, business, and geopolitical issues. So many of those issues I understand, but the strict banking and finance, that's not my background. So what I'll try to focus on today is what's happening today, and maybe touch a bit on what might happen in the future, but trying to predict into the future for something so multidisciplinary, so new and fast changing as this is going to be difficult. So about stable coins that you ask about, just to get to the basics of money. Money can be most anything. This pen, as many of you may know, this may be money. We can trade the pen and use it as a medium of exchange, a store of value. We can even theoretically use it as a unit of account. But good money has to be good for all of those features: medium of exchange, store of value, and unit of account. And what we know of as money, the euro and the dollar, this is money. Now, so it's stability. Stability is a key to what makes it's a key feature as to what makes things good money. If it's going to be too volatile like Bitcoin or something, that doesn't make it good money, and that's why Bitcoin is not really used as money. But stable coins, the objective is to have a stable value and be pegged to a particular peg like the euro or like the US dollar, or even a commodity, an ounce of gold. But even though they are theoretically pegged, they do deviate from their peg. There isn't a single stable coin. There was an excellent study by Annette Koss from the Bank of International Settlements, and she analyzed all the stable coins, and her conclusion was there's not a single stable coin that that never breaks their peg. So all of them broke their peg, and that's a problem, because if you want to have something that's money, it should be worth what it says it's worth all the time. So you in your question, and I'm going to say some things here that are going to be controversial, I think, to at least some of you and to people in the industry. But what is the real use of stablecoins today? In the future, the different uses will be found, and hopefully they will, because today stablecoins are really just used for crypto trading. They're the on-ramps and off-ramps if you want to trade crypto like Bitcoin and ETH. You would trade in and out of stablecoins such as Tether. Stablecoins are used for money laundering purposes, for all kinds of criminal and illegal activities. Another use of them is just the trading of them, because to maintain the peg, they need to be traded constantly, and that's how people, just like normal traders on Wall Street, they make their money based on very tiny margins. The trading provides liquidity for the stable coins at the same time as helping them by giving people those margins, helping them keep to their peg. There are theoretical, legitimate, legal uses of stablecoins for cheaper cross-border payments and normal purchases of goods and services. But there has been no evidence that's convinced me that stablecoins have been used to date for such legitimate purposes. Of course, the goal is in the future to be used as such, particularly in jurisdictions, say, for where the local currency is very unstable. That would be an advantage. So relative stability. There are some other uses that can be planned for stable coins because they may be programmable, such as smart contracts where things can happen based on certain events. But CBDCs, of course, this is another part of this discussion. CBDCs can also satisfy that kind of programmability demand if that's built in. So I hope that's kind of given a little introduction into my skeptical views on stablecoins.
It's very much, you have explained this very much difficult and new topic. I'm just further little focus on it, the stability part, because we have seen recently in my 2023, I'm also a trader at that time. So we have seen that the USD stablecoin, which is deepen, and within a week, there is billions of dollars has been rigged up. So my question is related to what are different type of stable coins? USD is what kind of stable coin, and how they maintain the stability, because stability is very much important right now. Even USDT, if we take it's almost $130 billion in that, so it's too much for the financial stability risk. So how can we understand that how they maintain their stability, which is very much core for the stable coin?
Sure. Well, you mentioned USDC and you mentioned Tether. Both of those are fiat-backed stablecoins. So those are stablecoins that are backed by assets denominated in a fiat currency, either backed by treasuries or backed by commercial paper that are liquid. The problem with stablecoins such as particularly Tether is that there are no audits, no proper audits on either USDC or Tether. There are these attestations by audit firms, but no proper audits as to what those assets are and how they're made up. And so that raises a question as to whether they are fully backed and how much stability that backing can offer and does provide to the stablecoin. I mean, one question is, say, particularly with Tether, is how much of the backing is essentially crypto-backed loans, where they'll create the Tether and loan the Tether to a company that buys crypto, and they buy some Bitcoin, and then the loan itself is the backing, either directly or indirectly, for Tether. So you've got crypto effectively backing Tether, and Tether stimulating and the demand for Bitcoin. That's a risk, and how much of a risk it is, time will tell. So you asked about the different types of stablecoins. Fiat-backed is one. Crypto-backed, where it's the stablecoins are backed by expressly by crypto, such as Bitcoin. That'll be, for example, Frax. Commodity-backed stablecoins, there are some that are fairly popular, more popular than they used to be. Gold, like this Tether Gold and this Pax Gold, that are backed by actual real gold, or so they say. That's another problem. Are there audits on those, on the amount of gold? If there's what are the rules for redemption? Can anybody get redemption, or is only large players that can get redemption? How easy it is? Who's holding the backing? Who's holding the fiat backing, or the crypto backing, or in this case the commodity backing? And then there's the unbacked stable coins, and we've seen the problems with them, the Terra Luna collapse. That's when there's algorithms or protocols that with trading, the vision is to have this stability, but sometimes it's just a vision, and the algorithm unbacked stable coins, they're just based on hope and belief that that's what they are, and that's what Terra Luna ended up to be, is just hope and belief. So I wouldn't really give any faith to unbacked stablecoins. There's a famous quotation that the primary reason people believe in anything is because others believe.
Exactly. That's great. Now, the last question regarding stablecoins, then we will proceed to CBDCs. Nowadays, we have seen that BIS and other financial institutions are focusing on regulation side of this thing. And it is something that very much important for all other economies. So what you see challenges surrounding these use of stablecoin and regulation regarding this in upcoming future?
Sure. Well, I touched on the fundamental problem is that with stablecoins, there are private issuers. Often it's unknown who the corporate entity is behind these. It's unknown sometimes where the assets reside. There are no proper audits. So there's no guarantee that the stablecoin issuer does have the assets and is able to redeem coins when you want the redemption. So this, of course, undermines the credibility and the ability to maintain that peg. So that raises a regulatory issue. But there's other regulatory issues too, that they because stablecoins are being used. Tether is infamously being used now for criminal activity such as money laundering, terrorist financing, tax evasion. There needs to be anti-money laundering regulations that apply, just like there are for other forms of payment today. It's the stablecoins are doing, it's the general principle of regulation is same risk, same rules, same regulation, same risk. So the risk of stablecoins and money laundering is the same for wire transfers as it is for stablecoins. So the same AML and anti-money laundering and KYC, know your customer rules, should apply. At the same time, consumer protection and data privacy laws should apply, because who's tracking? It's as a private issuer here, who's tracking all these money flows. Do you consent for that data to be kept by this private company? There's all kinds of rules about how the private information with banks is used, and of course, with regular cash, you get cash-like privacy. Tether, as you touched on, Tether now has over 100 billion in assets, and so there's a risk if there's a run on Tether. People want to get their Tether redeemed. Well, people are going to have to, well, Tether's going to have to redeem its backing, and that can cause instability to the financial system if that all happens and things unravel very quickly. So Tether is relying on its many years of reputation that it's done what it says it will do, and people can use it for the purposes they want it. But another quotation, Warren Buffett says it takes 20 years to build a reputation and 5 minutes to ruin it. So that's a risk. Other risks are the jurisdiction for the regulation. These are international currencies. What regulator applies, what rules, if there's redemptions necessary, where or what are the rules that apply, and where do you get that? And then audit requirements. These are issues, and they're international. Which jurisdiction is going to be applying those regulations?
Yeah, it's very comprehensive answer from your side. We have a little bit short our time, so we will go to CBDC directly. It's your short answer on this, that what are the CBDCs and stablecoin, and how they're different from a traditional fiat currency? How can a retail customer differentiate from this?
Well, the main difference, of course, of CBDC over the stablecoin is it's issued by the central bank. So it has the backing of the central bank as opposed to this private issuer that we've been talking about. And it will have different rules around it that cover off many of these issues that we just talked about, from the money laundering to the risks to the financial system and privacy.
Yeah, that's great. And nowadays the central bank is exploring these CBDCs. So what is the primary motivation for this, that all central banking are looking these CBDCs?
The primary motivation is the threat from big tech. Big tech, such as Apple, Google, they have their payment systems, PayPal, Facebook, all of these. And whether it's also MasterCard or Visa and other payment networks. Cash is issued by the central bank. So you take your money out of your ATM, and that's a liability of the central bank. But when it's deposited in the bank, it's a liability of the bank. With the payment networks and all the card companies and big tech, they're becoming more powerful because cash is being used less and less. It was accelerated with COVID, but because of online transactions. So central banks want to continue to provide a non-big tech way of payment. So you're not locked in. With Apple Pay, you're locked into the Apple ecosystem. And the point of the central banks is not only to maintain stability, but to maintain choice in payment systems. So you're not locked into big tech. So that's the biggest reason why central banks are looking at CBDCs.
Even I just want to add, because I'm in a developing countryside, so even a cash transaction, when Pakistan has a 70% cash transaction, but there is a corresponding banking system regulatory issue, and also the nation is focusing on the financial inclusion on that side. But I will come to
absolutely.
The next question about the CBDC, that how CBDC benefits the consumer, businesses, and government in the future. How you see in future that this will benefit these entities?
Well, the main reason that the central banks are putting, another reason is for efficiency, to lower costs. Right now, we see with credit cards, certainly in North America, but less so also in Europe, that there's large fees. So to make transactions more efficient and cheaper is, and not being locked into the current systems. Those are the main reasons. Government is looking to ensure the stability of the financial system, so that there isn't a run on the stable coins, which would cause a collapse of the currency. They want to maintain financial independence. Just the other week, Nigeria got very upset with Binance and has seemed to put under house arrest or some sort of restriction to Binance executives because the trading of their currency against a stable coin did cause a collapse in their currency. So they can lose control of their domestic monetary policy through issuing. They want to by CBDCs. They can maintain that control. Without CBDCs, they can lose control.
So one thing that is regarding CBDC is the problem of adoption. Even China has issued CBDCs, and they have a very controlled economy, authoritarian economy, but we didn't see that adoption. So if there is, it's the reaction against these crypto and stable coins. So how these CBDCs will survive and they will counter these upcoming short?
They have to offer something better than the current options. So a lot of rules and regulations may apply that may nudge people towards the CBDCs. They have to offer privacy, enhanced privacy over stable coins. People like cash-like privacy, but at the same time, they have to provide AML because to prevent criminal activity. As a bottom line it's a combination of regulations of the stable coins and the current payment systems, but at the same time the CBDC offering extra value, not just the guarantee by the central bank, but by offering privacy and convenience and more features and more availability that universal acceptance. So it's kind of it'll be a carrot and stick approach.
That means that it should be like digital cash. If they have the attribute like digital cash, then it will be a good CBDC. So
that's right. In fact, at this point, I have to put in a plug for a company that I'm an advisor to. It's you can check it out over the next year or two. They're launching now. It's called TotaQ, and they have a technology which is in fact a digital cash. So you can kind of consider it like a stable coin, but there's no blockchain, there's no database. It's actual distributing cash. But sorry, go ahead with your question.
That's great. The last question regarding CBDC, that what you see, which country and regions are leading in this CBDC development, and they will lead in the future, and other countries will follow.
Yeah, it's Europe. The European Central Bank is taking a leading role in this. I've traveled the world, talked to different central banks, and there are a lot that are studying them. The Bank of International Settlements is studying them, but of major jurisdictions, I'm talking major jurisdictions here, the only major jurisdiction that is taking an initiative for widespread adoption, as you mentioned, China has one, but it doesn't have the widespread adoption, and perhaps the lack of privacy may be one reason why it doesn't. But Europe, they've carefully studied it, and they're going to offer the design of the systems to offer cash-like privacy and to be universally accepted. They're taking a slow approach, but their aim is to launch it by October 2028. So they have all the pieces of the puzzle together. They're now soliciting technology providers that will actually implement all the features.
Okay, thank you. Now, just I want to come out from the CBDCs and stablecoin to the real economy like a problem. That how might CBDC and stablecoin impact this cross-border payment and digital identity? Because we have seen that there is a lot cost and time associated with this cross-border payments, and CBDCs and the stablecoins are affecting this time and cost to this. So how you see that it will impact this cross-border payment and digital identity? entity?
They may have no effect. It all depends on the regulations. For example, we talked about Europe. Europe is very clear that the rules that will apply it's a domestic currency. It's meant to be only used domestically. Only European entities, such as European citizens and residents, can have access to the currency. It's not meant for external to EU. So it depends on the regulations. What are the rules of the currency? The European Central Bank does not want to be used outside. We talked about stable coins. Yes, there is substantiated criminal use of stable coins for international payments, but of course that's not the goal here. The goal is to come up with an international payment system that's faster, better, cheaper than the current systems. So it may be that stable coins and CBDCs have no role in international, or very little role in legitimate international payments, just because more and more fast payment systems are being interconnected. And that may be maybe fast payment systems that have proper anti-money laundering controls and KYC controls, that they may be the trick. They may be what happens, and stablecoins and CBDCs may be limited in their application.
Okay, just related to this thing that if US issue a stable coin in future, it will be just like a dollar. So how it will affect these underdeveloping countries, because it's just like a digital dollar. So my question is this, that is the global stable coin is resolve these problems related to these cross-border payments and digital identity?
Well, first of all, I don't see much action from the U.S. Federal Reserve in issuing a U.S. CBDC. I see some talk, but I don't see any real action. And by the way, on that point, that's one reason why the European Central Bank is also proceeding forward very swiftly with their digital euro, because of their second to the United States, and they want to maintain at least that second, if not move up to first as far as Western currencies. So they're kind of in second place. So they need to try harder. But the United States doesn't need to try hard. It is the reserve currency of the world. So there's not much incentive for them to move forward. I think part of your question was, should the United States move forward with a CBDC? Would it be adopted more around the world, particularly in countries where there may be instability? I think you've seen that with regular U.S. cash. So that's a reasonable outcome, but that would be a long term. And again, looking forward to the future, like I said up front, this is it's an issue of so many different competing technologies, so many new technologies, so many different issues, law, regulation, finance, banking, geopolitics. There's a lot of geopolitics here of trying to, this Europe, and they're concerned about big tech. Well, another reason they're concerned about big tech is, and MasterCard and Visa, these are U.S. corporations. And so Europe wants domestically controlled corporations, European corporations, to be running their system, which is fair. It's for Europeans, and that is also going to be an issue for other countries too. That's where domestic policy, monetary policy, and domestic control, privacy laws, all of these things. It's looking into the future, and I don't have a crystal ball. A lot of things people predicted a year ago are not turning out today. So if I was to make any prediction now, I'm sure it wouldn't be. I'm sure there'd be a lot wrong with it, if not entirely wrong.
you had talked about it with banks and financial intermediary, and the real threat when I was studied the stablecoin from BIS perspective and other, that they have concern about that bank intermediation, because if central bank issue CBDC directly to these retail customer, so where there's banks, because banks is intermediating between central bank and retail customer. So my question is that how might CBDCs and this stablecoin influence the role of banks and financial intermediaries in future?
Well, excellent question. I mean, banks provide very important services in the financial industry. If just know your customer rules and AML regulation and controls. But they provide mortgages, and these are commercial retail banks, and so the banking system, to maintain the banking system, is very important to central banks. As central banks, if they issue CBDCs, they want to issue them in a responsible way, so it wouldn't unduly disrupt the existing system. In Europe, they have designed the system so that banks are integral to it. If you look at the digital euro rulebook, which was published at the beginning of this year, they maintain the intermediaries which provide the privacy. So essentially, the banks are the privacy intermediaries between there's the payer, there's the privacy intermediary of the payer, and then there's the payment network and central bank, and then this privacy intermediary bank with the payee. So the banks maintain their role in the system, but the design of the system is also very important. For example, just like cash, when a central bank issues cash, there's no interest paid on the cash. Likewise, with the digital euro, there will be no interest. They'll not be remunerated. At the same time, there will be limits on the amount. I think they're talking about 3,000 euros right now. It may be changed to a different number. That'll be the limit at any time that an individual, and only individuals, can hold the digital euro. Businesses, they can receive, but they have to deposit that in the banks. But there'll be a limit, and if the individual receives more, then that's automatically deposited in the bank as commercial bank money. So those are the kind of rules they're trying to build in to not disintermediate the banks.
Good, it's explained too much. Naveed have raised the hand, but we have a question and answer session at the end, and I will conclude just because there's a two question that I will ask, and then we will ask questions from you. We have also a guest from the staff of the European Central Bank here, and he is listening to us. So we will hear from him from the digital euro perspective. So I want to conclude within 5 minutes. My last question regarding the implication of stablecoin and CBDC on monetary sovereignty, especially in the least developed country, which I have lived. Because if these things came, digital cash is something that you can control it through a monetary policy. But if your people have access to these stable coins like USDT and these other things that now we are using here, so what will impact the monetary sovereignty and global financial infrastructure?
Well, that's an excellent question, and it's a huge question. Again, I'm not an economist. I'm not a banker. I'm not a finance guy. So I really can speak only very generally about these issues. I gave the example of what's happening in Nigeria right now with the finance people because of that issue. It's a big risk to the state, maintaining their monetary sovereignty. If people aren't using their local currency, that's going to affect the ability to affect the economy with setting interest rates and other monetary policy. I mentioned Facebook earlier. Facebook tried to introduce the Libra, then Diem stablecoin. Facebook's got about 2 billion customers. So instantly there would be 2 billion people potentially using this currency. For precisely these reasons, the central banks effectively shut it down. They said, no, Facebook, you're not doing it. Because I'll just give another quotation from Andrew Jackson. Money is power. And in that government, which pays all the public officers of the states, will all political power be substantially concentrated. So money is power. If big tech controls the money supply, that would reduce the central bank's monetary sovereignty. CBDCs, that's another reason to maintain that sovereignty, to boost efficiencies of the payment system, to reduce dependence on all these payment providers, such as the credit card companies and big tech. Another reason that people don't talk about enough is that by issuing a CBDC, the central bank essentially gets to profit with a free, from what they call a seniorage, right? So they're issuing essentially themselves a free loan by issuing money. So that's another benefit to the taxpayer. So there's all these benefits of CBDCs, but there's so many unknowns.
This is really, the future will tell us that what going to happen, because it's a very much complex things. Lastly, just on your comments shortly on these CBDC and stablecoins, what is the implication for privacy, data security, and digital identity for which they are born? And we have seen this stablecoin here around us.
Huge issues. I mean, we know. Well, stable coins, think of them like PayPal has a stable coin that they've issued. Apple Pay, Google Pay, they're not technically stable coins, but we know that the same issues with the stable coins or payment methods from big tech, they're all wrapped up. I mean, together. If you pay with Apple Pay, you pay with Google Pay, possibly you pay with PayPal's stable coin. The big tech will get all that information about everything you're buying, just like the credit cards companies do today. But the credit card companies, they don't sell you stuff based on what your payment data is, whereas big tech does. They can target you by using your data. They can use price discrimination, charge certain people more than others. So they're in the business model of leveraging the data that they have. That is big tech. That's how Amazon works. What you buy determines what they're trying to sell you in the future. Same with all big tech. That is their whole business model. So with the CBDC, built into it would be privacy protections that would not allow that to happen.
That's great. Bob, you have explained these typical questions which I ask from the perspective on the future, and you have explained very well. Now we have almost a 15 minutes, because we have a very special guest and all other colleagues which are working on this topic. So I want to listen from them. First, the Naveed have raised the hand and he has a question, so he can ask. Please unmute your mic. Is Naveed there?
Thank you. Yes. Thank you, Mr. Saleem, and thank you, Mr. Bob, for such a wonderful session. My question is just related to the global acceptance of these stable coins. That what it makes US to shy away from, issuing a new global order by issuing a new global order, so that it has a vast acceptance of these stable coins, like the one mentioned by the Mr. Bob in the session regarding the PayPal stable coin. But this is one tech joint which issues the stable coin. I am much concerned about the global order regarding the universal acceptance of just like the US dollar. So why it is taking that much time? And another question that I would add to this is what is the potential loss to the developing countries like us, like Pakistan, where we are much dependent on the IMF and the World Bank? So I am kind of worried about the future that the developing countries must not rest with the hands of these tech giants by developing their own stable coins pegged with the US dollar, but they have that ecosystem. So what is the potential loss in threat for the developing countries? Thank you. This is my question.
Well, there's a big geopolitical threat. I think you were asking about the European countries, and another reason they're adopting the digital euro is that the payment systems right now, there's 12 countries in the euro area that the MasterCard and Visa payment systems they run all, not just MasterCard and Visa payments, but all electronic payments in those 12 countries. So MasterCard and Visa are foreign countries. Therefore, from a geopolitical perspective, the US can exert pressure on Europe by applying pressure on MasterCard and Visa. And this is real. We saw it when Russia invaded Ukraine. The US effectively controls the SWIFT international payments network, and they applied pressure on SWIFT to shut down almost all Russian banks' access to the SWIFT network. So this is a geopolitical issue between different countries. You asked also about adoption of stable coins. It comes down to trust and utility. What's faster, better, and cheaper? That's when things will be adopted. So better, trust is a big factor here. Do you trust it more? Faster, does it do a better job than the current systems for international transfers? Well, if all the domestic fast transfer systems connect up internationally, you may not need stable coins. And cheaper. What are the transaction costs? We see high transaction costs now, but those for international payments under payment systems as opposed to stable coins, but those costs are going down. So it depends on the size of the transaction. So we're going to get adoption when there's all those features, particularly trust, in the stable coins. And right now, with the stable coins that you have, the private stable coins, there's not a lot of trust, and that's why they're not really being used for legitimate transactions.
Okay, that's great. Anyone who have a question? Okay, we have an online question. He said that Mr. Gerhardt, I'm just pronouncing maybe that he introduced yours because you know that, but I come to a question. It's a very detailed question that that's to say through our smartphone, I can send you a money token. It will be gone forever from my smartphone without any ledger. My understanding, he said. Can you talk about this technology and are there any central bank interested using a kind of this technology in their CBDC? He is just talking about the blockchains. They use this technology right now.
Yes, this is the company that I advise. It's TodaQ. You can check it out, todaq.net. They've got a micropayments implementation right now. And yes, it's a system that replicates cash, so that with cash, you have it in your pocket and you give it to someone else. It's a bearer asset, right? The physical cash, right? Dollar bill. I take it out of my pocket. You're here. I give it to you. You have it. I don't have it anymore. And that is a transaction that is very easy. It's cheap. There's no third party. There's no bank. There's no blockchain. This company, TodaQ, has replicated that methodology of doing a payment by digitally. So that there is no blockchain. It's just actually a data file that sits on your phone, as Kiko was mentioning, and you transfer it to the other person. It can be transferred by email. It could even be transferred with an API call where computers connect up together. So that's the current implementation is for micropayments, and it's so efficient that it can be used for as little as a tenth of a penny transaction. All other payment networks right now, the cost of the transaction is at least 14 cents, not necessarily what's being charged, but the cost of running the whole system is 14 cents. So this is very efficient because there's no third party involved. It's the actual service channel where you're receiving the data from, or let's say it's an electronic service. You're actually using that to transfer the money. So that's an example of a new technology that's becoming available that can provide for CBDCs. This is a technology that's being considered by central banks, but it's also a technology that makes things more efficient. It can maintain privacy because, again, there's no third party, there's no recording in a blockchain, there's no third party database. It's got cash-like privacy, but because it's got features of advanced features built in, you can also build in anti-money laundering controls and other rules. So thanks for the question. Thanks for the opportunity to talk about the company that I'm very very keen about.
It's a great technology because blockchain is doing on this. I just ask a short short comment on this. If there is no blockchain, no third party, so it's solved the double spending problem. So how it solved it? Shortly, if you comment on this, we have another question too, and short of a time too.
Yes. So if in the real world, if I was to give you a €100 note and I was to ask you for your computer in return, before you gave me your computer in return for handing over, you would look at that €100 note, and you would look at it in the light to see about the watermarks. You would feel the plasticky substrate, the paper of it. You would check that it's valid. That it's real before you'd hand over your computer. So the same thing with this TOTAQ technology. When you have the data file worth €500 on your phone or any other device, and if I want to send you €100, I would encode 100 of those euros into a separate data file that would be encoded with your wallet, send it to you. And this is where the magic comes in. You would get that file, and then automatically and instantly, your wallet would send a hash of that file. So just a few kilobytes hash of the file to one of many competing validation networks. And it's a zero knowledge proof. So those validation networks would not know about who our transaction is, anything about our transaction, who we were. And then automatically, based on that hash, it would send back a hash. And with that hash that's received, your wallet would be able to determine the validity, the integrity of the file that I sent you. And the file would say it's worth $1, it's issued by this bank, and it has not been spent before. And I had owned it, and I'm now giving it to you. So all that integrity is validated by the hash.
Thank you so much. You explained very well, and I'm interested now in this thing, and we will explore that how this will be a future technology. We have a 5-minute. Adam, Naveed has asked a question that I have a question. Can we ask it, or we concluded this session because we have just 4 or 5 minutes? Okay, Naveed, shortly you ask questions, and because we have a limited time, so you ask a question.
Okay, thank you. I will just stick to the clock. My question is, I am kind of a pessimist regarding these stablecoin. I'm just, kind of worried about that the specific ecosystem of these tech giants. What if these stablecoins again promote the global monopoly of these giants? And what if the developing countries, again, stuck in such vicious circle of economic dependence on these joints in terms of global monopoly of these joints? My question is just about this, the monopoly threat. Thank you, Bob.
Yes, so this is the biggest reason why the central banks are looking to issue CBDCs, is that big tech threat. I don't think many people want big tech to be controlling all our lives. They control enough of it as it is. Do we want to give them complete control over the payment systems? So we need to give people an option, a free option. People, also for those who don't have credit cards, who don't have bank accounts, the financial inclusion aspect of it. But it's the privacy, it's the monetary sovereignty, it's the economic sovereignty, geopolitical sovereignty. It's providing people with a free payment system, a cheaper payment system, a universally available payment system. There can be rules and regulations that can be put in place for big tech in the interim, or instead of CBDCs that put in place all those requirements so that people are not disadvantaged. But how effective will those be? Already, I mean, right now, it just happened this week that Apple in the US, the FTC, and in Europe, also the antitrust regulators are going after Apple because of their business model. Their business model is with their phones. 30% of it, any app that's sold on their phones, and also 30% of anything that's sold inside any app that's sold on their phones. That goes to Apple. So that because they've got an effective monopoly, and people have to. I mean, it's the Apple Pay system that's built into the app. That's regulated, and it's going to be more regulated. So, how do we keep people in control as opposed to big tech in control? These are issues that we have to face.
Okay, thank you. Aneesha, I have a question, so you can ask a question.
Sorry, I'll be taking up your time, but I just wanted to get a practitioner's feel for this question. When I say that monetary authorities by themselves have enough on their plate already, and they're already trying to map their own autonomy. They're fighting as a banker to the government, at the same time managing the macroeconomic situation. How would you then say that putting this further on them to manage something like a CBDC, maintain wallets, privacy, keys, such and such, are we trying to say that now you have to do everything or fight from all angles? And yeah, a practitioner's view for this point would be very interesting.
You're right. It's a big ask this is not an area where central banks have played before. They haven't played in technology. They contract companies to print money for them. They have commercial banks which distribute the money, but this is something new. They have to get their arms around new technologies, new rules. And this is why it's going slow. This is why a lot of central banks are looking at it, but they're not really moving forward. There's big risk here too. Central banks it's about financial stability. If they launch a CBDC and it doesn't work because they're not experts in it, that is going to be a potential disaster for confidence in their currency.
Okay, thank you, Bob. I think we have no more questions. So, and our time is also over. So thank you so much for all being here. It was a great session. We have learned a lot from you, Bob. You have discussed and explained these things very much in a very comprehensive way. We have also another project here in Pakistan and the stablecoin shaping the future money. You are all encouraged and you want to participate, so just go there and submit your abstract. This will be a great session on these stablecoins and the perspective on least developing countries. So once again, thank you so much, Bob. Thank you, everyone being here. It was a great session. Let's see in the future, and thank you so much.
My pleasure.
Good to see you, Bob. Take
Great
care.
to see you, Kiko. Oh, you're on the plane. Okay, fantastic.
Yeah, in the train. Yeah, thank you. Thank you
you.
for your comments.
Thank you, everyone.
Great.
Thank
My
you.
pleasure. Thank you for all your questions.
Thank you, everybody. Bye-bye.
Bye-bye.
Bye-bye.